Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is November 21st, and it is The Talking Point. Thank you so much for joining me. I really appreciate it. And before I close, I want to wish everyone a very, very good Thanksgiving. With all of the issues that we've faced and now the flu going around and hitting our children across the country, we still have so much to be thankful for. And I thank you, every single person who gets in touch with me, who calls me, emails me, corrects me, by the way. Yes, corrects me. I thank you so very much. But let's look at this market. These 2 weeks, this week and next week, historically are two of the best weeks for the market, statistically. And yet you see hesitancy in the market. Let me go over that. The worries in the market, as everyone knows, is the Fed, whether or not are we in a recession, as the conference board's leading economic indicators, suggested, hey, we may not be in a recession right now, but we're sure slipping into one. Then the question of what kind of recession? Is it just going to be a profit recession with companies, having slower and slower earnings? Or will it also include an overall economic recession? After all, I do want to stress this, the 3-month Treasury yield inverted with the 10-year has been an extremely strong guide to recessions all the way back to the 1960s. If we don't have a recession in the next 12 months, it will be the first time that the 3-month and 10-year inverted yield curve is wrong. I just want to point that out. But also understand, too, that just because you have a recession doesn't mean it's one of those gory, deep recessions. It could be a pretty fleeting, short-lived recession. So the market has to deal with all of that. But in terms of seasonality, coupled with the mid-year elections being finished and that we head into gridlock, which, by the way, the market doesn't mind at all, we should see a market that wants to go and conquer the S&P 500 4,000. That's the level that this market needs to conquer in order to gain some more momentum, right? I just want to point that out. Also, as we came into this couple of weeks, we saw a heavy dose of put buying. What is put buying, for those who don't know? It is basically, I am buying protection to the downside on the S&P 500. If I thought that the S&P 500 was going to march right through S&P 500 4,000 and climb even higher, I'd be buying calls, right? Because call buying gives me an opportunity to make money if the S&P climbs higher. And also, by the way, I could buy this on individual stocks. But nonetheless, we saw one of the heaviest bouts of put buying that we have seen in a long time. It means that traders and investors are saying, yeah, I know there's seasonality. I know that we should be doing better. But what about a just in case? So keep that in mind. But nonetheless, seasonality is strong right now, and we may actually see the market saying, you know what? I like the fact that Disney is in new hands, that Mickey Mouse has a new and beloved leader. Maybe the market sees that as a positive sign. Plus the fact that I do want to point out that the S&P earnings so far, with virtually over 90% of the earnings in, that we have seen earnings up 4.2% for the third quarter so far. I will tell you that without energy, it would have contracted to just below 4%. Nonetheless, the market has rewarded those companies that have positive guidance. And that includes, for example, Walmart. You saw Walmart came out and said, hey, things looked okay. We saw Macy's had positive guidance too. So it isn't as if everything was awful. It's actually been much less terrible than many of the analysts had suggested coming into the third quarter earnings season. So Tomorrow, Tuesday, we'll hear from Nordstrom. And on Wednesday, I want to point out there's going to be an awful lot of economic data, but the market is focused on the Fed minutes. Now, it always astounds me that the market is so focused on Fed minutes, and the reason is it's been non-stop Federal Reserve speakers. In fact, one of them, and I won't name names in this call, actually said, I really think the Fed needs to go to 7% in order to just lick inflation in its tracks. The market did not care for that. So, as the terminal rate, by the way, the market has to figure out on its own where are we headed. We will get some idea, and I do want to point this out, not necessarily this week, but next week we will have the personal consumptions expenditures index, the PCE, which is the Fed's favorite view of inflation. And then back on December 13th, just before the December 14th rate announcement, will be the consumer price index. This is going to give the market a really good sense of where inflation is, where it was, because you're always looking back where it's headed. I can also say that every list that I look at from the top analysts, and even my own view on inflation, where I go out and take a look at where prices are, they're coming down. The supply challenges are eased, if not, just gone. Prices are coming down across the board. And so the question is, how much evidence does the Fed need before it makes a comment that inflation has plateaued and the job towards price stability is getting a little bit easier? So let's just remember, the Fed's job is to bring us to price stability. And I think these next inflation reports are going to indicate that that job is being made easier. For the market, however, it is, are you still going to keep raising rates even at 50 basis points, which is what the market expects, by the way, for the December 14th rate increase. The data that we're going to have this week will be durable goods on Wednesday, new home sales, unemployment claims rising. This is an interesting one because we still have many job openings. However, more and more companies across the spectrum, not just in tech, are announcing that they're going to start hiring freezes and even layoffs. We are going to hear from Consumer Sentiment, University of Michigan. Again, important. Why? Because this will be the final report. And in that report, what we want to see is what consumer expectations are for inflation over a 5-year period. This is important because we saw it inch higher. We need to see it pull back. And this will come out on Wednesday. Also, S&P Global, remember, this is another group that looks at purchasing manager indexes, will have a flash report. That means it's not the final report, but that report will be on manufacturing and services. I can tell you that from last week, we saw the Philadelphia Fed survey on manufacturing, which is very much related to the Mid-Atlantic. It came down. The report came down, new orders down, expectations down, and so on. This morning, we had a report out of the Chicago report. That also was down. We are also looking at the numbers coming out of Black Friday. Why do they call it Black Friday? It's because historically, it's when retailers go into the green. They're no longer in the red, they go into the black. They're making money. Retailers have been, how shall I say, doing holiday sales since before Halloween. So we know, we heard from Walmart. We saw Target still having problems. But nonetheless, we've heard from a number of companies saying, hey, you know what? It hasn't been bad at all. They're putting sales on early, very, very early. And so Black Friday will give us some indication of how they're doing, a deeper indication. But also, you have Cyber Monday. I don't know if these matter so much anymore because folks have been ordering online for so long now, and the online sales have been going on too. Also, this week, we are going to get a sense of, I think I mentioned durable goods, but overall, I think the market is so focused on the Fed minutes to see if they can pull out anything that hasn't been covered by this parade, nonstop talking by Fed officials. So I don't know if they'll find anything, but nonetheless, that becomes an important one, and that's this coming out on Wednesday afternoon. It's a shortened week, there's no doubt about it. And on Friday, it's short for the market and the bond market. But keep in mind, the 2-year Treasury yield is still telling us that the Fed still has a way to go. Remember, it is most closely associated with the Fed policy. The 3-month and the 10-year still inverted, and that's important because, again, it has a stellar reputation for calling an inflation a recession. That recession isn't a month away. It could be 9 months away. So there's so much for the market to absorb. But again, right now, in terms of seasonality, this is a very strong period for the market. Again, the Fed, more Fed speakers before they go into the blackout period could, how shall I say, push the market in one direction or another. I also add here before we say goodbye that volume comes down. And when volume in the market comes down, it means that it could be skewed very easily in one direction or another. Let's keep that in mind. Last but not least, the world's second largest economy, China. Remember, the market has been focused on that, saying, well, come on in because the Chinese valuations are, so deep because of the zero COVID policy. We've seen the Chinese market just be a favorite for traders and maybe some investors. However, right now is a test case for the investing world. China is going through another round of COVID. There are deaths being announced. The question will be, do they stay with their targeted policy versus a complete lockdown? What markets want to see with China is that they can live with COVID, that as the West lives with COVID, and that therefore they can get their economy growing again. Remember, the Chinese central bank has not been tightening. On the contrary, they're now offering easier rates for the property debt-laden market, easier rates for consumers who want to buy homes and condos. So it isn't as if they are constrained by tighter financial conditions. On the contrary. But above all else, what the market wants to see is, can you live with COVID and not lock down the economy the way you've been doing it for 2 years and leading to a languishing economic backdrop? It's a test case right now for the market. I will say goodbye now. Have, again, a wonderful Thanksgiving. Please don't hesitate to get in touch. I'll be back to you. I'll be back on Friday, Thursday and Friday. Not Thursday, but tomorrow, Tuesday and Wednesday and Friday again. And, of course, next week. As the market navigates the Federal Reserve, earnings, and the dollar, and whether or not this economy can hold up. It has been extremely resilient. Think about the NATO scare. Think about the unwinding in some of the crypto world. The market has held up, and that is an indication of a basically strong, resilient market. Let's see how we do by the end of this week. Thank you so much. Take good care.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.